Yeah, here I am again with some remarks continuing the information on German trade tax, and we are going on with the trade profit computation or the rules to compute that tax base for the trade tax. And we are still here, third chapter of chapter 3. And let's talk about some example cases for the add-back rules contained in 8 number 1 of the Trade Tax Act, as I told you that before. Let's look to the case. Case 1 is X GmbH has its only permanent establishment in Cologne, that's Köln in Germany. The city tax rate is 475% for the trade tax. X GmbH had a corporation tax profit of finally 500,034 euro. During the computation of that profit, the following amounts have been taken into account. Naturally, they have been taken into account correctly. Lease payments for machines used by X GmbH 500,000, interest paid to banks 200,000, interest paid to a shareholder 150,000, but adequate interest would only have been 100,000, rent paid for a factory building 200,000, license fees for the right to use a patent right which is held by a foreign company 800,000, and X GmbH is neither subjected to the rules of the interest barrier nor to the rules of the license barrier because it does not fulfill the requirements or the criteria for the application of any of these rules. Now the question is, solve the case, or better, how high will be the trade profit of X GmbH and how high will be the final trade tax? Okay. Let's stop a bit, think a bit about the case, and then try to solve it. Okay, let's begin at the beginning, and the beginning should be tax liability. You remember, there is neither an unlimited nor a limited tax liability for trade tax because there is no difference between inland taxation and worldwide taxation. Trade taxes only on inland permanent establishments. So X GmbH is subject to trade tax. That was in paragraph 2, and now we have to look for the appropriate, adequate, correct subsection, and this was section 2 of the Gewerbesteuergesetz of the Trade Tax Act. Then we just have to think about the tax base computation. The first thing we can say is the tax base is the trade profit. That can be found in paragraph 6. Originally, decades ago, that was just an important rule which says trade tax base is trade profit, trade capital, and wage amounts. But it has been reduced over time. You remember that only the trade profit is left over, and that trade profit is to compute it as income from business under income tax or corporation tax rules adjusted by modifications laid down in paragraphs 8 and 9 of the Trade Tax Act, and that can be seen in paragraph 7. So that is our kind of general introduction. Now, after the general introduction, let's get concrete. 2.1, the lease payments for machines. There is an add back for rent payments for machines. So to be added back under paragraph 8 number and now 1 letter D with 20% of the paid amount. So here with 20% of 500,000, so plus 100,000 is the necessary add back. 2.2, these are the interest paid to banks or interest payments to bank. Paid number 1 letter A orders a full add back. So that is plus 500. 2, 3. Interest paid to shareholder only 100,000 are acknowledged as interest. The rest is hidden profit distribution. The consequences of the hidden profit distribution must have already been drawn during the computation of the corporation tax profit. You know, that is not accepted as a business expense, but that mistake or that aspect must have already been dealt with when the corporation tax profit was correctly computed. So remaining interest to be added back is only 100,000. The rent paid for a building, 50% are to be added back under UDEL, under 8 number 1 letter E of the Trade Tax Act. Naturally, you look that up. So half of it, 100,000, 2.5 the license fees, 1/4 has to be added back. Here, 1/4 of 800,000, that is 200,000. Paragraph 8, number 1, letter F of the Trade Tax Act. The exception for the social security contributions for artists does not apply here because a patent right is not covered by a social security system for artists. And otherwise I would have needed to tell you so. So now we have number 3, adding it all up. First step, add backs under paragraph 8 number 1, because we will always have to compute them separately from other add backs which we later learn about. So what we have here is now, due to number 1 we had 100,000, due to number 2 we had 500,000, due to number 3 we had 100,000 again, number 4 is 100,000 again, and number 5 is 200,000 again. That leads us to a brutal result of, now let's try to calculate this. No, seems to be 1 million. Can that be true, ladies and gentlemen? 1 million. Yeah, indeed. Now, minus free allowance of minus 200,000. So new subtotal is 800,000. And to be added back 1/4 of that, that's 200,000. You remember that wise idea that, well, quartering always comes as the last step. That's indeed the case. So we have now the total amount of the add backs under paragraph 8 number 1, and now we can compute the final trade profit. So that's now B computation trade profit. Finally, we have income from business. That was 500,054 plus add backs under paragraph 8 number 1 plus 200,000. That gives a subtotal of 700,034. Now, if you look to paragraph 11, you have to round that down to a value which has even 100s. So we have to get rid of that 34 euros at the end. Then there is sometimes a free allowance, but not for a GmbH. No free allowance under paragraph 11.1. So it remains 700,000. Times 3.5% trade tax multiplier. That is in 11.2, and that leads us to a number which we quickly have to compute. The result is 24,500, and now times the city multiplier for Cologne, Germany, 475%. Paragraph 16.1 says this, and if we apply that, let me have a look. And then we end up with 116,375 euro as the final tax burden for this company. And that's it, ladies and gentlemen. That's evidently enough. So that was this first case, plain and simple. Now it is in all probability easy to guess what comes next after case 1, that is probably case 2. So let's look to case 2. Now this is not a GmbH, this is an OHG and a partnership this way with 3 partners, which are surprisingly named A, B, and C. The ABCOHG, oh my god, has seat and place of management in Düsseldorf, which is in Germany, and Düsseldorf has at the moment, that is in the year of 2021, a city multiplier for trade tax of 440%. Now, the OHG has made a profit of 138,945. However, we arrived at that. During the computation of the OHG's income from business, the following events have been correctly taken into account. First, there was an interest payment made to different banks, in total 2 million. A license payment made to one of the partners, 300,000. Then there was royalties paid to a foreign, non-related recipient of the royalties, 800,000. Rent was paid for machines, 500,000. Rent was paid for a building, 400,000. And the ABCOHG is again neither subjected to the rules of the interest barrier nor to the rules of the license barrier, so neither for H nor for J ESDG, because it does not fulfill the relevant criteria for each of these rules. The question is again, solve the case for trade tax, or to be more precise, how high will be the trade profit of X GmbH? No, oh my god, sorry, that was a mistake of copy and paste. How high will be the trade profit of ABCOHG naturally, and how high will be the trade tax finally? So that is what we have to deal with, and that is where we are going to think about immediately. So let's take a sheet of paper, take a pen, stop your video here if you can, try to take your Tax Act translations, or if you're German, perhaps the original Tax Act, as you like, and then try to solve that case, and afterwards resume that video and then look the solution. Okay, so here we have case 2 now in front of us, and we begin again with the beginning, which is always a very wise approach. The beginning was tax liability, and now we have to look for the tax liability rule for a partnership. So that was here the OHG, as owner of that business, is liable to trade tax under paragraph 2, and that was section 1 because it's an enterprise as defined in the Income Tax Act. So then we have to think about trade tax base, and we have a general introduction which we can think about, and that is the tax base is the so-called trade profit. Paragraph 6. That's to be determined as income from business under ESDG rules, adjusted by modifications laid down in paragraphs 8 and 9 of the Trade Tax Act. By the way, the plus modifications are in paragraph 8 and the minus modifications, so the deductions, are always in paragraph 9, just to give you some orientation. So here the starting value is income from business 187,945. Now we have 2.1. The question that we have to look for adjustments, the interest payments to banks, 2.0 million. There is a full add back under paragraph 8, number 1. Now look up the letter, and it was the first mentioned thing, so letter A, and that is that we know plus 2.0 million. 2.2 license payments are to be added back with 1/4 of the paid amount, but these license payments go to one of the partners, so they are not acknowledged as license payments from the perspective of German income tax law, have never been business expense, do not exist for tax law, so no add-backs, because if there are no license fees, then you can't add them back. Royalties to a foreigner to be added. These now exist, surprisingly, because they are not paid to a partner. To be added back with 1/4 of the amount. See paragraph 8, number 1, and now that was the last, and that was letter F. Never do this from your memory. Always look it up in the list in paragraph 8, number 1. So to be added back is plus 200,000. 2.4 rent paid for machines. The rent paid for machines is to be added back with 1/5, so with 20% of 500,000. See paragraph 8, number 1, letter, and it was a D. No, this is Gewerbesteuergesetz, the Trade Tax Act. So what we have to add back here is plus 100,000. 2.5 rent for building, 400,000. Half of it has to be added back. under paragraph 8, number 1, letter E, because such a building would be a fixed asset, blah blah, and so on, if we didn't, if we owned it ourselves. Half of it has to be added back, so plus 200,000. Now we are finished with all the events, and so we can start additions. 3.1. The first step is always the add backs under paragraph 8, number 1. Gewerbegesetz. This is here now because of event number 1, 2 million. Because of 2, it's a 0. Because of 3, this is 200,000. Because of 4, this is 100,000. Because of 5, it's... So we end up with 2,500,000. Yeah? Minus a free allowance, ladies and gentlemen, of 200,000. So we have a remaining amount of 2,300,000. 1/4 of that has to be added back. And now here, let's turn to our calculators, and 2.300 million times 0.25, 575,000 only. Okay. Now let's hop over to a new sheet of paper, because my old one is relatively finished now. And now we have 3.2 second step. The final computation of the trade profit. Here we have income from business, that was 187,945 plus the add backs. And just to look that up again, that was 575,000, yes. So plus 575,000. There we end up with a subtotal, a new one. And again, let's turn to our calculators, because calculating by heart is usually not so easy. I admit that. So 713,945. Now this is to be rounded down to even 100. So to 700,911, 1 of the trade tax. Now minus a free allowance or not. And a free allowance is given for natural persons and partnerships. And as the OAG is a partnership, that applies here. So we can deduct and must deduct a free allowance of 24,500, C11(1), number 1 of the Trade Tax Act. So we end up with a new subtotal, which is now surprising, 713,900 minus 24,500, 689,400. This is now taken times 3.5%. That's in 11.2. That's that is the computation of the final trade tax base or trade tax assignment base, however you call it. And the result is 24,129 euro. And now the last step is now the computation of the trade tax. That is now the city multiplier of 440% für Düsseldorf, 16.1 Gewerbesteuergesetz applied to that trade tax assessment base of 24,129, and that leads to the enormous amount of 106,167.60 euro. It might be, and it will be expectable that under some rules of the administration, the 60 cents or something else is not really collected, that something is rounded down a bit or up. That does not really interest us here, because we are interested in the basic principles of tax law. So if something happens to that 60 cents or not, this is not decisive for us. Well, so you have now already seen a second case, and if you really made a small break, took a sheet of paper and did that case and now can compare with my solution, congratulations if you had, for example, the total amount of the add backs correctly calculated, and naturally the free allowance at the end was probably a kind of a surprise for you still, because we have not yet talked about that before. So don't bother about that, don't reproach that to yourselves. We are going to speak about things like this a bit later, and that teaches you that probably in all tax cases there are always surprises. You should never be overconfident. Yeah, but however, in the end, it was, I hope, relatively simply to understand. Good. Then let's stop doing this and turn to doing something new, speaking about other adjustments which are necessary. Now, the next topic we have to talk about is that there are also adjustments for profits which have to do with amounts which come not from this firm, but from other firms. And the most important thing is you have to keep these adjustments strictly separated from the ones under 8 number 1. So they would never be included in that first list of adjustments. That is why I always began with first step 8 number 1 adjustments, and then you turn over to doing the rest. So keep them strictly separated from the 8 number 1 stuff. That's the first thing. But what are we talking about just now? The basic idea of the trade tax was to tax the profit of a certain firm. That is what you have already understood. We want to tax that business. For example, a business in Cologne. So we want to tax the profit of that business in Cologne. Now please watch the following situation. We have here firm A, and firm A shows a total profit for this year of 500,000. Now there is also a second firm, the ABOHG. Let's say it's in Munich, and that's a partnership where firm A holds 50% or so. They have a profit of 400,000, and now the profit share of 50% at the end of the year, let's say this was covered and included in the profit computation of firm A. So 200,000 are included in the balance sheet and profit and loss statement of firm A. And so we can agree to the logical conclusion that if these 200,000 came from Munich, from the partnership in Munich, only the rest of the 500,000, so only 300,000 can really have been produced in firm A. Because if the total was 500 and 200 was included coming from Munich, from another firm, then the only thing generated in our firm A, let's say in Cologne, can only have been 300,000. Now, if we want to tax the amount from Cologne, the profit from the firm in Cologne, then it's a necessary conclusion that we must say, okay, these 200,000 from Munich partnership have to be eliminated from the profit of A if they have been included in that bookkeeping there. And that is exactly what you will find in a section for the minus corrections, the minus modifications, paragraph 9. Number 2, if you want to have a look, take a look, and if you don't want to have a look into the legal sources, you should have a look. So we do have a look here to the translation of paragraph 9 Trade Tax Act. Here number 2 says, after the introduction, which is still valid, the total of the profit from business and add-backs is decreased or lowered by blah blah and so on. And then number 2, the shares in the profit from a full partnership, limited partnership, or any other partnership in which the partner can be considered as a co-entrepreneur, irrespective of it's located in the inland or abroad, if those shares have been included when the profit from business was calculated. Naturally, that condition is clear. Only law experts, judges, and other people who are far away from the world could come from the formalistic idea that you should eliminate an amount if it has not been formally included. But just to clarify that and to make the rule idiot-proof, you have here that last sentence. It's only eliminated from the calculation if it had been included first. That's plain and clear. So here you have the rule: shares from a partnership, profits from another partnership have to be eliminated because they are not a part of the profit of this firm, but profit from another firm. Now, naturally, the same logic applies to losses from another firm which have been included into your computation of your business income for this firm. Firm A again, let's say in Cologne, reports in total a profit of 500,000. Now there is also AB OHG, a partnership in Munich, let's say Munich, in which they hold a share of 50%, and surprise, this time Munich produced a loss of 400,000, and so they had to bear 50%, so 200,000. So the loss has reduced the result from Cologne, and after deduction of the loss, we had 500,000 left over. Now, do we agree that before that loss had been deducted, that loss which came from Munich, the original total must have been higher? So we should agree that if after the deduction of the losses we end up with 500,000, evidently before the losses came into play, Cologne must have earned 700,000, not 500,000. And now if we want to tax the business in Cologne, everything which has nothing to do with that business but with other business should be kicked out. So the loss should be eliminated, and that is exactly what is ordered by the Trade Tax Act. And now that means the loss to be eliminated means you have to add back the loss, because before you deducted the loss. So reverting that, eliminating that, means adding plus 200,000 again, arriving at 700,000. That is the explanation why you find such a rule. Losses from a partnership have to be added back. You find such a rule in paragraph 8, because paragraph 8 are always the entries which increase the trade profit. Let's have again a look on the legal text. Paragraph 8, to the profit from business, paragraph 7, the following amounts are to be added back as far as they have been deducted during the computation. Number 8, the share in the loss of a partnership in the inland or abroad, being a full partnership, a limited partnership, or any other partnership where the partners are to be regarded as co-entrepreneurs of a business. So we have to kick these things out. Okay, that's simple. Wherever you have a profit share in a partnership, this is something from another business. You have to eliminate it from the computation if it were included before, and then you just have to distinguish if you eliminate a loss or a profit, either plus or minus. Now, profits could also come from companies, so juridical persons. GmbHs, AGs, limited companies, or whatever you call it. Now we have again firm A, let's say sole trader or what else. This firm reports for this year a profit of 500,000. Now there is another firm, this is B GmbH, and let's say B GmbH is again somewhere in Munich. Now B GmbH made a profit of 400,000 and B GmbH decided to pay out the whole amount as a dividend, and so A got a share of 50%, so 200,000. 200,000 dividend went to A. Now let's again begin to think about things. I hope we can agree that the profit which has its origin in the firm A from Cologne is only that amount without the dividend, because the dividend is an amount which came from another firm, from the firm B GmbH in Munich. So we should agree that the dividend should be eliminated from the profit. Now that leads us directly to one question. The dividend, with which amount is it included still in the income from business of A? Now you would probably say, oh, it was 200,000. You get a dividend of 200,000, so you book 200,000. Half of the truth. Now, the income from business, ladies and gentlemen, is not the result from the profit and loss statement, but the income from business is the tax result, so the correct tax profit of firm A. And now you have all learned at the one time or another that dividends usually are taxed in a privileged way. You get very often a kind of a discount. For example, under German law, if a dividend ends up in the hands of a natural person and that is not classified as income from capital, then that natural person gets a 40% discount, a kind of tax exemption, or what? No, a kind of, no, a real tax exemption. 40% of the dividend are tax-free under 3 number 40 ESDG. So only the remaining 60% are still included. That means if you get a dividend of 200,000 in your income from business, that dividend is no longer included with 200,000, but with a lower value. So if A is a natural person, the profit which has its origin in the firm A is only, let's look here, dividend 200,000, 40% tax-free, dividend only included with 120,000, so we only have to eliminate 120,000 because that dividend was in the income from business only included with 120,000. Remove it from the 500,000, so we end up with a taxable trade tax amount of 380,000. That was the amount which was evidently produced in Cologne, in the firm A. The other amount was a dividend from another firm, had its origin in another firm, should not be taxed in Cologne. If the recipient A was a juridical person, then the calculation changes. A has a profit of 500,000. Dividend from B GmbH is included in the bookkeeping. But now we have to say, okay, we have already become a bit cautious. We don't know if it's really the full amount, so let's think about it a bit. We should agree that whichever amount is there representing the dividend in the final income from business should be kicked out. So let's think about that. If we have a dividend of 200,000, then that dividend will be declared completely tax-free under 8B KSDG under the circumstance, naturally, or under the condition that the participation is at least 10%. If that is the case, let's assume this, then in the income from business, the tax, the income and corporation tax result, that business has already been completely kicked out. So the remaining amount of the dividend included in the 500,000 was at that time 0. That means in that case, if 0 is still included in the 500,000, we kick out 0 from the 500,000, and so we end up with 500,000. Surprising, but nice. In the case of a partnership, we had also to think about the problem of losses. This is the problem which you can completely forget in cases of a capital company. The problem can't show up because if you have a subsidiary company, you know there is a limitation of liability. The shareholder is not responsible to take over the losses from the GmbH or AG or limited company or what else it is. So that a shareholder has losses from the subsidiary in his or her own profit calculation is not possible. So we don't need to take that problem into account. However, the German legislator decided to make our life a bit more complicated by introducing an exception for certain dividends, because the dividend revenue from small participations is not treated as income from a different firm, but rather qualified as the return of a monetary investment of this firm, so the Cologne firm. And so such a dividend from a small participation will be treated as fully taxable revenue within the context of trade tax. So not partly, fully. Just think about an example. Business number one has a liquidity of 500,000 and they store their money in a bank account. So they get from time to time a small interest revenue, let's say 0.1%, 500 euro. Or they pay in these times even negative interest. But in times when they still got an interest revenue, it was absolutely clear and general consent that this interest was not produced by another firm. It was regarded as the revenue from a monetary investment, a liquidity reserve of the firm. It was always qualified in full as a part of the business profit. Now imagine somebody else comes to the nice idea, why should we hold our liquidity in form of cash on a bank account? There are other forms of holding liquidity in a way which is nearly as easy and far more productive and probably charged with less fees. So imagine there is some other business owner who says, well, I am going to hold at least that part of my liquidity which I do not need tomorrow, but perhaps only for unforeseen occasions, or in the medium run or in the long run, I park that money in form of shares in the stock exchange. The idea is the stock exchange will never charge me with negative interest. There is a certain protection against inflation because the value of shares usually develops over time in adjustment to inflation. I can quickly turn that amount into cash, and if there is no major crisis or so, then I will always make profit in the long and medium run. I will perhaps even get from time to time some dividends, which are definitively higher than what I can get as interest. And so if I don't need that money tomorrow, this is the far more profitable way to store my liquidity. So you can see, or you can argue, it's not a necessary view which you must hold, but you can understand it's a potential possible way of viewing things, that investment in single shares or small participations is nothing else than, or should be comparable to, holding money in a bank account. These two things can be regarded as economic alternatives. So it should not be treated differently. So you can say, again, not a necessary conclusion, but a potential possible one, that if you tax interest revenue in full in the trade tax, you should also include dividend revenue from such a liquidity investment in full. And that is what the German trade tax law decided to do. Dividends coming from small participations, in the extreme case from single shares, are not exempted, but on the contrary, they are fully taxed. So even if there was a tax exemption under the income tax law, it's fully reversed. Full taxation of dividends or full exemption. There is no compromise in trade tax, either 100% out in case of high participations or 100% in taxation in case of low participations. Now, naturally, we can sum that up. There is either full taxation or full exemption. It depends on high or low participation. And if you have a high participation, that's clear, then you own a second firm. It's comparable to having a partnership in an OAG in Munich. Now you have 50% or 60% in a GmbH in Munich, so that money, that dividend clearly comes from another firm, is not a part of the result of your firm. On the other hand, if you have only a small participation, then it's regarded as, or can be compared to a monetary investment. It's just comparable to interest from a bank account. So small participations down to a single share would imply that dividend must be taxed in full. Good. Now you have the orientation. Small participations, trade tax, dividends, full tax, and high ones fully exempt. Now the only thing we need to find out is how high a participation is and what is high enough for the exemption and what is small under the perspective of Trade Tax Act. And now you come to something which can no longer be understood in common sense, because what is clear is the dividend from a single share also, yes, that can be compared to interest from a short time capital investment or so. But naturally, one would probably never guess where the German Trade Tax Act draws the line. They say 15% or higher is necessary for qualifying a participation as high enough for the exemption. So even higher than the participation threshold under the KSTG. Some decades ago it was identical, but later the cities had a financial crisis, and therefore just monetary reasons the threshold was pushed up from 10 to 15%. There is no justifiable logic behind that. So only when you own 15% of another firm, of a GmbH or AG or a limited company or what else, at the beginning of the assessment period, only then your dividend revenue will be tax-free in full. If not, so if you own 14.9% or so, then full taxation of the dividend under trade tax. By the way, ladies and gentlemen, that makes clear that if you are an enterprise, either a natural person partnership or a GmbH, that doesn't matter, and you have the unfortunate situation that you are the proud owner of 14.999% of another corporation, then you will be desperately looking for the acquisition of one single additional share, probably before next year begins, because you need at the beginning of the year one single additional share. Now imagine the situation that one shareholder has 85%, another one has 14.999%, and you, ladies and gentlemen, have the one and only outstanding share on earth. They will probably try to hunt you down during your holidays with a helicopter. Somebody will drop down with a parachute and make you an offer to buy your last share in order to push up the own participation threshold to 15%, so to become free of the trade tax. You can imagine that a reasonable person will then never be willing to sell that share for its percentage value. Let's say the nominal value is 50 euro, the fair value would be 200. But then you would probably say, no, I know that if I sell you my last share, then you will in all the next years save, let's say, 10% or 15% taxes on hundreds of millions coming from the dividends. So make an offer. And the number 200 is okay, but it should be a 200,000 and not a 200. And so it can be that such a last share can be highly valued. Well, that's just to underline the economic consequences of such strange thresholds. Okay. So to sum up the rules, for dividend revenue under trade tax, we have first, if the participation is 15% or higher, then the dividend is fully eliminated from the trade tax base. And if in the income from business, so the result which counted for income tax or corporation tax, there is still a rest of the dividend included, you kick it out. And if you want to lower the amount, you need to look in paragraph 9 of the Trade Tax Act. And depending on which company it is, you either choose 2A in that company or 7 and 8. This is for companies abroad paying a dividend. However, if the threshold is not met, if your participation is lower than 15% at the beginning of the year, then the dividend has to be fully taxed. In such a case, all the parts of the dividend which have been freed under income or corporation tax have to be added up again until you reach again 100% of the dividend. That is laid down in 8 number 5 of the Trade Tax Act, and that makes dividend treatment interesting. Example number 1, ladies and gentlemen. You have a single merchant, sole trader, that is signalized in German law with the abbreviation EK, Einzelkaufmann, eingetragener Kaufmann, so registered merchant. That firm received a dividend from a 5% participation, 100,000, and a dividend from a 50% participation of 600,000. Now, what are the consequences for trade tax? First, the 5% participation is too low, so the dividend has to be fully taxed under trade tax. That means fully taxed with 100,000. Now, the income from business, that was the income tax result. There, the dividend was, however, only taxable with 60% because 40% are tax exempt under income tax. So the income from business, the income tax number was only 60,000. We need 100,000, so we have to correct this by adding back the missing 40,000 again, see 8 number 5. The 50% participation shall be fully exempt. So income tax, however, says only 40% was tax exempt, so 360,000 was still included in the income from business. So we have to kick them out completely. That is 9 number 2A, Trade Tax Act. So you have to deduct 360,000 to be correct with that item here. So we have a final result. Income from business was 500,000. We had to add back 40,000, that part of the dividend which should be fully taxable, and eliminate that rest of the tax-free dividend, and so we end up with 180,000. Example 2 is now the same situation basically, but now with a GmbH. And again, we have 500,000, we have 5% participation and 50% participation, even the same amounts. What are the consequences for trade tax? The 5% participation is lower than 15%, so the dividend must be fully taxed. In the income from business, the corporation tax result, this dividend was already fully taxable under 8b4 KSDG, because 8b4 KSDG says if a participation is lower than 10%, then a dividend is fully taxable. So this is already identical with the result we want to have here, so no change is needed. The 50% participation is higher than 15%, naturally 15. So this dividend must be fully exempt from trade tax. And under the rules for corporation tax, this dividend was already completely tax-free when corporation tax profit was computed. That was 8b1 KSDG. And that is already identical to what we wanted to have, so no correction under this aspect. Final result, 500,000, correction no, 500,000, trade tax relevant amount. Okay, then example 3. That brings along a bit of fun, because now X GmbH has a 12% participation in Y GmbH, and the dividend received by X GmbH is 100,000. Now, under the rules of corporation tax law, that dividend was fully exempt 8b1, and only 5% lump sum for the costs were added back, so we had a taxable remains of only 5,000 or so. Now, under the trade tax, that dividend must be fully taxable because it's not 15% or more. So all the 100,000 have to be included in the final result. We have to add back the revenue in full plus 100,000. On the other hand, when the revenue is fully taxable, then the inner reason for eliminating a part of the cost as non-deductible falls away. So we can also eliminate that lump sum of 5,000 by declaring deductible now. So the overall change is plus 95,000. That is exactly that amount which under corporation tax was missing to full taxability if you see revenue and expense treatment together. Yeah. So let's have a look again to the legal sources. Here in 8 number 5, you find that general rule: whenever you need to have a full taxation of a dividend, then everything has to be added back, which was freed under income or corporation tax, until you end up the full 100%. That is prescribed for all the situations where you are not entitled to push down the dividend revenue to 0. That is expressed here: the amount of dividends and similar amounts which are tax-free under 3 number 40 or 8b1 KSDG are added back as far as they do not fulfill the requirements laid down in paragraph 9, numbers 2a, 7, or 8 or so, after deduction of the corresponding expense, as far as this remains unrecognized under 3C2 or 8b5. So the difference between the non-deductible expense and the revenue, the tax-free revenue, is to be added back. The last sentence has lost its significance by a reform of the Foreign Relations Tax Act. Paragraph 9. Now we have here dividends from shares in a corporation with place of management and statutory seat abroad is eliminated from the profit if the business has owned a participation of at least 15% in that corporation, and paragraph 9, number 2a, sentence 3 to 5 are to be applied accordingly. Then you have a special rule in 9.8 for dividends which are declared exempt under a double taxation treaty. Now, that made sense in former times when 9 number 7 was far more complicated. In former times, 9 number 7 was not so simple as it is today. Because in former times, 9 number 7 had approximately a full page of conditions that the dividend was only exempted if the foreign subsidiary did the right things, so-called active activities and blah blah. Really a mass of conditions had to be fulfilled, and that explained why sometimes then number 8 said, well, if we were more generous in a double taxation treaty, then that also applies to the trade tax. So if in a double taxation treaty for the exemption of dividends we renounced on so many of these conditions which we formally posed, then we also renounce on that for trade tax. But some years ago, some court decision of the European Court of Justice said we have free movement of capital, and that means people who invest money abroad and get dividends from abroad shall not be treated in a more negative way than people who get a dividend from the inland. And when you receive a dividend from the inland, no real conditions are posed. So you are not allowed to ask such conditions here. So now that is the reason why the dividend exemption rule for foreign dividends has been simplified so greatly. And I really have now the suspicion that 9 number 8 is now completely superfluous. But one never knows, and probably that is also the reason why the ministry has not convinced the federal parliament just to skip that 9 number 8 rule. I think they would probably like to be on the safe side. But I cannot really imagine any additional way or situation where you could be forced or where it could make sense to apply 9 number 8, which was not already covered by the new version of 9 number 7. And now, as I already mentioned several times, 9 number 2a, we should end with that inland dividend regulation, which says the total profit from business is to be lowered or decreased by number 2a, dividends from a non-exempted inland corporation in the sense of 2.2. If the parties, that means capital companies, if the participation amounts to at least 15% of the statutory capital at the beginning of the assessment period, and the profits from the participation have been included when the business profit was calculated. Then there is a rule that expense which is directly related to the tax-free dividend shall be deducted from the tax-free amount, so that only the net amount of the dividend, so revenue minus costs, will be free of tax. And yeah, okay, that shall be enough for this video. I thank you that you have the patience to watch it, if you had it naturally only. And I hope to see you again soon for another part of these videos. Thanks for watching. Goodbye till next time.